Let's now then connect with Anand Rathi, who is the chairman, Anand Rathi Private Wealth Management, as well as Feroze Aziz, Deputy CEO, Anand Rathi Private Wealth Management, to talk about the Q4 snapshot. Thank you so much, gentlemen, for taking time out and joining in. To begin with then, Mr. Rathi, how was the performance of all the three verticals in the year gone by as compared to what we saw in the industry? Because it has been fairly strong over the last few years. So will FY24, according to you, be a year of consolidation, or will the momentum continue?
We have posted the final profit of 168 crores. Our original guidance when we started the year was 155, which we revised is to 165, and that is 168. So performance, I believe because the other results have not yet come, other industry people. But I believe that our results in a given difficult year, the last year the markets hardly moved. In spite of all that, I think we have been able to produce what we expected, much better than what we expected in the beginning of the year. Now, talking of the current year, I think our current year would also continue to be a growth year, because I think we believe there is a huge opportunity in this market. And as we are growing and as our value proposition is finding favor with the customers, even in difficult times, we believe that we will be able to grow continuously, and momentum of growth will be maintained. We always say that, we can grow our AUM by 20-25% year on year. And once AUM grows, obviously the revenues and profitability will continue to grow like that.
Right. Feroze, if I could get you in on the discussion as well. How is the investor sentiment on ground right now? And are you seeing any hesitance in the current environment, given that, what Mr. Rathi was saying, the markets have not gone anywhere in the past year? Do you see challenges then to growth ahead?
I think what happens is investor sentiment actually dampens new investors. See, today we have 7-8 lakh HNIs in the country, out of which we have 1%. But there are several HNIs who have currently invested with our competitors in the industry. We as a wealth management outfit have always believed in measuring risk and managing it. When in bad times, when they see Anand Rathi Wealth clients doing significantly well, not just on the return parameter, but also on the volatility parameter, then they like to join hands with us. You're absolutely right. When the market sentiment isn't good, I'm not going to get a lot of new clients added to the industry. But the clients who are already there in the industry is looking for some sound advisor who can help him or her sail through difficult times. In bad times, we have seen that new client addition is as healthy, if not more. So old clients give us more money because there is a difference between a good advisor or a good distributor and a bad distributor apparent to naked eye in bad times.
Okay, so the clients are giving you money. So how have the inflows been? Could you segregate the flows between equity, mutual fund, debt? Where is it exactly flowing into?
So what has happened is, since we don't focus on all the 20 different product lines, because we believe in giving our clients what we buy for ourselves. So that limits our choices to equity mutual fund, debt mutual fund, structure products largely. So equity mutual funds, because in our belief, this client set has been doctored to think that when market falls is the best time to buy equity. Most people say it, but not able to act on it. See, we as our clients have been told that when market falls, you need to act and buy cheap. Is why you would see that a 36% or 37% is what our percentage in equity mutual fund was. That moved to 46, and now it has moved to 47%. So the largest portion of the net mobilization has come in the equity mutual funds. Since the market was lower for the last 1 year, our clients exhibit courage because they are long-term intergenerational investors. So to answer your pointed question, the largest portion of net mobilization, which grew by 78% for the year, there was a growth of more than 100% or more in equity mutual funds. And I think that's something which will pay off in the future, because you're buying low and not just staying in the sidelines waiting for further corrections.
All right, Feroze, what about your outlook on the equity market share? That currently stands at 1%. Do you plan to take that higher, and what would be the timeline for this?
So when you look at equity mutual fund market share, our market share is lower. If you leave SIP AUMs aside, our market share is 1.5%. But if you look at the overall equity mutual fund assets, our market share is 1.16%. We intend to grow it to 2 to 3%, in fact, 3% in the next 3 years to 4 years. How do we intend to do that? Is because we focus on very few things. Equity mutual fund is one of them, not like one of the 20 things we focus on. Mathematically, our model portfolios in the mutual fund side have done phenomenally well, beating Nifty by about 3% compounded over the last 9.5 years. This credibility is helping us beat several other distributors in terms of client performance. And when we are able to mathematically measure and establish to people that dealing on equity mutual fund side with Anand Rathi Wealth Limited is definitely a safer choice and has the potential to give that extra return, which is why you buy a mutual fund. That's mathematical measurement of our credibility in terms of performance on the equity mutual fund selection process, which is a proprietary process developed and evolved over 10 years. That's helping us increase our market share on mutual funds. And you will see that if last year in terms of net addition, we had 17% of the total net mobilization other than SIPs coming from ARWL, in spite of the market share being 1%. 17% of the net mobilization apart from SIPs came from ARWL.
Sure. Mr. Rathi, you managed to grow your AUMs just short of 20% of your target. What is the AUM growth that we can expect for the full fiscal given the current challenging environment? And would you be able to maintain long-term guidance of 20 to 25% range of growth?
Okay, I think as we mentioned that this year's growth of 18% is in spite of very little growth in the market, If because the equity markets have not done well. Normally, as we said that about 8 to 10% increase should come because of that, which didn't happen. In spite of that, we got 18% growth. In this year, we expect, again, 20% growth. Our AUM, which is about 39,000 crores this year, we expect it to cross 47,000 crores by next year. That's the change which we expect in. And we think that if this year is going to be good, 20% should look a conservative estimate.
Feroze, recently we have seen a lot of changes when it comes to the debt, flows as well because of the change in the LTCG tax calculation, etc. What's been the impact on the flows there? Was there a big ramp up in the month of March?
Yes, I think this change of including debt funds into Section 50AA is a reasonable change. Nobody can deny that. But I think having said which, I think Section 50AA has been very reasonable on two counts, saying that if you mix equity and debt, then there is no change. So inflows will continue, especially on the retail side, by mixing products which have both equity and debt and not just debt or gold or any other asset class standalone. So I think the product platforms will undergo a change. Some degree of innovation, arbitrage funds will take the piece of the cake. But having said which, when you look at ARWL, we are dealing with clients who are intergenerational wealth. When you're looking at intergenerational wealth, debt has a very small role to play. In terms of risk mitigation, we use structure products to bring down the risk of portfolios rather than plain vanilla debt, which brings down the risk but equivalently bring down the return. So ARWL, no impact. Industry, there is an impact, but I personally believe the industry has several levers of innovation which they will use to get the long-term money back into the debt side, but not as standalone debt funds, but hybrid funds, equity savings funds, which have 30-40% in equity, will be the flavor. Dynamic bond funds will at least have 35-40%. So I think industry will grab their pound of flesh from the debt allocations by mixing both the assets rather than keeping debt separate.
All right, Mr. Rathi, Feroze, thank you for taking time out and joining in and giving us more clarity on the financials.